Well, hello, traders and investors. Today is September 21st. We're going to be opening up in about an hour and a half or so. The markets are now pre-opened down about 500 points on the Dow. I want to get through the global week, the fundamentals. Then I want to get through the calendar. And then I'm going to give you a top NASDAQ 100 stock that appears to be breaking down. And I'm going to give you a trade, an option trade, risk level, protection level, and all the other good stuff, and give you the rationale of why I believe the stock is losing steam, and while it may be a good opportunity for a short-term pullback trade. Not a pullback trade, actually, but a short trade. Sorry, I had that one wrong. So let's talk about Wall Street, and let's see what's going on. And again, markets are down heavy overnight. Global markets and U.S. futures tumbled Monday after Wall Street fell for a third straight week, and investors are rattled by U.S.-Chinese tension over technology and security and a rise in British COVID-19 cases. And I've said it before and I said it again, but we really don't need this U.S.-Chinese tension right now when we're trying to make heads or tails out of this COVID-19. But President Trump is posturing, and I guess he wants to prove a point, but it's not really that germane to the stock market right now. It would be much better to see it recover first before putting international tension on the market again. Market momentum shifted after the Federal Reserve said last week that U.S. economic outlook is uncertain, something that we've been talking about for a while. Growth in some industries has definitely slowed, and additional unemployment benefits that supported consumer spending expired. Lawmakers have yet to agree on a new support package ahead of the election, and I think we have, 43 days to go till the election? So we don't have a lot of time left, and we've got a lot of things to decide. On Friday, the White House added to tension with Beijing by announcing downloads of the popular Chinese-owned messaging app WeChat could be banned as a security risk. Trump and China are at it again. Federal judge agreed on Saturday to postpone the WeChat restrictions on the ground they might interfere with free speech. The same day, President Trump endorsed an agreement for TikTok, a unit of Chinese ByteDance Limited, to form a U.S. company with Oracle and Walmart. Trump is all over the place with China. Here's the really bad news. On Sunday, British government reported 4,422 new COVID-19 infections. COVID-19 infections, its biggest daily rise since early May. That's bad, really, really bad, because this may be the situation that's going to come our way in the U.S. as well and in China, and that's not something we need right now. An official estimate shows new cases and hospital admissions are doubling every week. Here we go again. Global markets have recovered most of this year's losses, though the bulks of the gains came from big tech and stay-at-home stocks. Investors have been encouraged by central bank infusion of credit into struggling markets, but we haven't seen anything yet. Show me the money, and we haven't seen a vaccine that's supposed to be coming out any month now. So it's one of those things where investors are losing a little bit of faith. Forecasters warn, however, that the rebound might be too early, which is something that I'm thinking as well. Uncertainties, economic activity, and number of infections are rising in U.S., Brazil, and other countries. Governments have reimposed anti-disease controls that hamper businesses. And to add insult to injury, crude oil is below the $41 frackers price level in the U.S. that they accumulate crude oil for. And that means we may see more downside ahead in energy stocks and energy prices. Now, I wanted to show you my momentum levels because I want to show you that we are almost there in terms of the short-term correction. If you look at the NASDAQ 100, we had only this is the problem right here. We have 78% of stocks trading above the 200-day moving average, and it never came off post. Here, let me show you. This is what I've been afraid about, and it's happening exactly as I expected. If you go to long-term period, you see how momentum, this line represents number of stocks trading above the 200-day moving average in the NASDAQ 100. And you see how it's cooling off, and it looks like it's going to go down further. Now, that's the 200-day moving average. You can argue that it could stay up here for a while. For example, look at this here, or look at this here. So that's a long-term indicator, but it is getting slightly bearish. But here's the major problem. The major problem is when you look at the NASDAQ, the number of stocks in the NASDAQ trading above the 50-day moving average, I drew this circle about 4 months ago, 4 months ago, and I told you that momentum levels is going to be cooling off. And we're now at the 33rd, and we're opening about 500 points down on the Dow. We're probably going to go down to the 27, 26. I'm expecting this level to go into the teens. I'm not going to be very comfortable till this level goes into 10, 20, 13, 14, 15 level, probably right below 20th. That's where I need it to go. And again, I told you this was going to happen a long time ago. When it goes to this area, above 89th percentile, it typically cools off. In this case, it went to 99th percentile. And this is over 20 years. And if you currently, what did I want to show you? I wanted to show you the S&P 500. Actually, no, I wanted to show you something else. I wanted to show you the overall momentum levels. So you could see here that in the S&P 500, only 50% of stocks are trading above the 200-day moving average, whereas on Wall Street, on the NASDAQ, I keep saying Wall Street, whereas on the NASDAQ, you have almost 80%. And if this goes down by 1%, literally 1%, this is all stocks trading over $2 that have been trading minimum of 6 months. So this represents the overall stock market. We're not that bullish. We're literally a hair above a bear market. And when you take that into account with what I'm seeing on the NASDAQ, with this moving lower, it's telling us that we may be down for a little bit more downside, which means we may hit the 200-day moving average or go lower on the NASDAQ. And when you take that into account with the fact that the overall stock market is holding on to a bull market by a hair, it's not that pretty. And that's why today I want to give you a short trade. Now, a few weeks ago, I introduced my inside day setup. Inside day setup occurs when the market makes a high or a low, and then the 2 days following that are inside that price range. So it's like a miniature triangle. Let me show you what I'm talking about. Let me show you this little miniature triangle. You see that? Like a mini triangle. And a triangle is a congestion and it's a consolidation pattern. Now, this is a inside day low. Sometimes we'll have an inside day high, but this is an inside day low because it's breaking my lower levels and it's below the 50-day moving average. And I want to show you something important. If you look at the trend line, the highs, notice this high couldn't take out the high that came around June, July. That's really, really important. I want to see stocks breaking higher, not lower. So the fact that it failed this high and the fact that it's breaking down and it's had 2 inside days and the NASDAQ is down right now quite a bit and so is the S&P, tells me that there's a good chance that this stock is going to hit the 200-day moving average. So right now I am bearish on Spotify and I like the fact that it's trading an inside day, which gives us lower risk. So I would put a sell stop right below here. I would put a sell stop right below the second day, right at the 225.40 level, 225.20 level. Yeah, 220. How about this? 225. Let's make it 225 right here. Yeah, let's put it right here at that level, 225 level. And if it trades above 242, I would liquidate. So we're selling it at 225 and we're liquidating it at 242. 225 entry on a stop, liquidating at 242 on a buy stop. Now, if you're trading option, you wait for your short alert to hit, and then you would put an alert at the buy stop, and then when this gets hit, you would liquidate the option. So you're trading the option as a proxy for the stock. You would sell at 225 the stock, and then buy the put option, and I'll tell you which put option to buy. Or if it breaks above 242, then you 242, 243, you probably don't want to trade the stock. So if you're going to trade the stock, your entry is at 225 on a sell stop, and your exit is at 242 on a buy stop. Now, if you're trading the option, and it's already at 230, so it's already approaching our level right now, pre-market. Now, let's look at the option. The option, we want to give ourselves a good time. So we'll give ourselves 63 days. That way, if we buy the option and if it doesn't do anything in about 20 days, we're out. So we're looking at a 225. Let's see where the open interest and volume is. The volume is dead on these stocks. Let's see if it's got a little more volume here. Oh, yeah, we got a little more volume. Let's see if we can get a little more volume going. Open interest is pretty good here. I think we'll just stay here. There's very little open interest. Let's see how the puts are. Oh, yeah, there's some open interest on the puts. So what I would do is, honestly, I'd go with the 220. By the time it goes down below 225, open interest is going to be higher here. And you're probably not going to pay, you're probably going to pay about $19 if I had to guess. Because remember, we're waiting for it to trade lower than it is right now. So you're probably going to pay about 20 bucks for this option. And again, you want the 220 strike price put, not the call, the put, 220 strike price put, and you want the put that expires in 63 days. That way, you buy this put now, you're going to pay a little more than it costs now because you're still waiting for it to drop about 5 points. So you're going to pay close to 20 bucks for this put. You're going to hold it for about 20 days, and if it hits the 242 level, you're out. Or if it doesn't do anything for about 3 weeks, you're out. But Spotify right now is a short. The tech sector's selling off. NASDAQ is cooling off. The broad market is having selling session. We're below the 50-day moving average. The overall market, only about 50% of the stocks are trading above the 200-day moving average. So there's still a lot of lopsidedness to this market. But again, I believe we're going to see a selling, some cool off, and a good low-risk trade is Spotify. And again, here is the reason why we've had the recent high couldn't take us above the summer high. That's a weak sign. And I know they're doing a lot of restructuring. They just moved they moved from YouTube to their own online network. So again, now you have to pay a premium to watch Joe Rogan's show. That's been moved to Spotify. And I'm not sure if this stock has the type of upside potential that the company is expecting, especially in light of the expenses they have. So I'm not happy that the high is lower, and the fact that we broke the 50-day moving average, the fact that this trend is getting weaker, and the fact that the market is going through a distribution mode. Also, you're seeing lower momentum levels here as well. So I am selling the stock now, and my profit target would be right at the 200-day moving average. So we would sell at the 225, and we would cover at about 185 or so. And my buy stop is right above. That's what I like about the inside day. It's a very low risk trade. It waits for a stock. It finds the trend, beginning of a new trend, and then it waits for a stock to cool off and lower volatility. Lower volatility, lower risk. Higher volatility, higher risk. So we're waiting for 2 days. We made a low here, a new low, and then we're waiting for 2 inside days before going lower again. So it's a low risk trade. We would enter at 225, and we would cover ourselves at 242, 243, around that level. Now, folks, before you go, I've got something huge for you today. Now, something really big, and I've been waiting all weekend for this. I've really outdone myself this time. I'm going to pat myself on the back. I'm so eager to learn the secret behind the trading legend Chuck Trophy trades that I've convinced him to come to Jacksonville. That's right, I've been talking to Chuck Hughes, the 10 times international trading champion. And he's been showing me these trophy trades, and I've been salivating. I'm not kidding. I invited him to our office to show us everything. This trade strategy is so powerful that everyone needs to know about it. I mean, in fact, this system could have earned you $13.5 million in the past 20 years. That's 20 years without a down year. Can you imagine taking $13.5 million out of the market without a down year? By the way, that's over $50,000 a month. Imagine having an extra $56,000 plus a month for the last 20 years to spend. That's what Chuck's going to be talking about. He's the 10 times world trading champion. He's made over $13.5 million. You'll see account statements. This is all documented. He's got testimonials with pictures, account statements. I've never seen proof like this in my life, okay? So it's all completely documented, and he's opening up his books to you. Folks, life is unpredictable, but trophy trades are not. Chuck Hughes is going to show it to you all himself. We're going to be there together. You cannot afford to miss this. I've had to call in some major favors to get Chuck here. He's going to be here live today. Follow the link below to see it for yourself. You're going to love this. And have a great day. Give me feedback. Post some feedback for me. Talk to you guys soon. Bye.